And today we're going to look at Citigroup possibly exiting the distressed debt trading business. And joining us now is Bloomberg's Natarajan to talk about it. One thing that I'm confused about is that if Citi exits distressed debt trading, then who starts to fill that void?
Well, the challenge with this business is it has already dwindled. There are only a few big key players, at least when it comes to the sell-side firms. It's a handful of players who are serious contenders in distress. Citi, perhaps not so in December 2023, but if you go back a year or two, you would easily count them among the top 4 or 5 distressed debt operations because you think about the research that comes with it, the idea generation, the trading, the ability to take illiquid stuff off of your clients and then find other willing buyers for that product. Not a lot of players there. Bank of America, Goldman Sachs, Citi was one of them. Now, CEO Jane Fraser has decided to hit the kill switch on another Wall Street operation. This is coming not too long after their decision to get out of the muni finance business, a storied franchise under Citi. But all this goes back to the broader story playing out at Citigroup. Yep. You have a bank where return on equity is in the mid-single digits, and they need to do something quick to lift it to their peer levels.
Sri, when this works, it works really well. But when it doesn't, it doesn't. And it also consumes a lot of capital. Isn't this exactly the kind of business that you wouldn't want to be in if you're Jane Fraser?
That's the challenge with a business like this. It's very hard to look at it from a year-to-year basis. If you look at the distressed business at Citigroup in 2022, in 2023, does not look that great. But 2021 was very good. When you look at some of the players who've actually stayed put in that business, they've had to take a longer-term view. They can't look at it every 365 days. And I'll give you 2 very important examples across the Atlantic. Credit Suisse, 2018-2019, decided to kill off their distressed debt business under Tijan, put extreme pressure on their prime and equities franchise, and we know how the story played out there. On the other hand, you had a player like Deutsche Bank that actually managed to carry out the transformation in part because of the success in its distressed trading business in 2020 and beyond.
I want to switch gears from risky debt trading to risky debt. If you think about this private credit play that so many banks are trying to now make, JP Morgan, Citigroup trying to copy this private credit playbook, one of the best stories of the day, really. Why wouldn't regulators say, hey, we didn't want you to put this risk on your balance sheet, so why would we be okay with you instead taking investor money and becoming a private credit firm instead?
So it's important to take a step back and look at how the markets evolved. 40 years ago, anyone needed a loan, you go to a bank and the bank makes a loan. Then along came Mike Milken and you had the birth of the junk bond market. Then you had the syndicated loan market. But in the last few years, you've had this astonishing rise of the private credit market. Has existed for many years, but crazy increase in interest in that market. It's a $1.6 trillion market. And what that has done is made sure that banks, which really had grown to rely on the profits from their lucrative leverage trading business, leverage lending business, are in serious risk of losing fees. They want a cut of the action. So now, instead of banks just being in the moving business, you're going to see a little bit of part storage, part moving so that they don't miss out on the action.